Okay, well, good morning, everybody. Wonderful to have you all online. Many joining us even as we speak. February the 24th, we've got a great lineup for you this morning. Gary Green from Key Business Consultants, it's his own firm. He is regarded as one of the UK specialists in the early stage tax area, and he's going to talk to us this morning about SEIS and EIS tax investing. There are many questions that I get asked about SEIS, tax certificates, submitting my tax certificate to my accountant to get my capital and income allowances allocated in the right tax year. And so Gary is one of, as I say, the great experts in the country to actually talk about this amazing subject. Many of us will obviously think that governments don't innovate, but actually we think, and I think, that the government can innovate and have done in this particular area around tax. And Gary and I have just been chatting somewhat informally as you've been arriving to just work out where, in fact, all of this came about. And Gary, correct me if I'm wrong, I think the original creator of this was Kenneth Clarke, as he was Chancellor way back in 1994, and that was for the EIS programme. Would that be correct?
Yeah, we were just looking at that, weren't we?
We were.
The EIS came in 1994 and the SEIS in 2014. Which was, remind me, it was George Osborne, wasn't it? You're saying? George
Osborne.
Who brought the CDIS to add to the EIS scheme, yeah.
So there's absolutely no doubt that this program works. It is extremely attractive for angel investors. We have just seen our first exit, and the exit overall for investors in that exit was a 5x. But for those investors that got in early, it was an 18x. So there is money to be made, but there will be tax to be paid. So with that, I'm actually going to hand you over to Gary, who's going to go through some slides with you, and then we'll come back for Q&A. If you'd like to put your questions on the chat line, we'll go through those after Gary's presentation. Gary, thank you. Over to you.
Thank you. So I'm going to try and share my screen, and then you'll be able to see a PowerPoint presentation for our booklet that we've created about the scheme. So I'm hoping everyone can see this. Thanks. So we've got sections. What is CDIS? Mainly it's a booklet for CDIS because when I started my practice in 2012, 2013, this was around the time that the CDIS was being announced in the 2013-2014 tax year. So we sort of almost immediately said we're going to specialise and market for the CDIS. But I'll talk about the EIS scheme at the same time. Slight differences between the two schemes. So what is CDIS? How does it work? Who's it for? What's in it for me, for the investor? I'm a small business. What's in it for me? Some examples and how to get into the application. So I'll try and hide this if I can. Okay. Yeah. So what is CDIS? CDIS is the most generous tax advantage venture capital scheme ever. What it does is it allows investors to invest in the share capital of startup companies. In exchange for investing in the equity for shares, the investor gets back an income tax credit, 50% against their income tax bill. So what that means in this example, the maximum amount an investor can invest in a year is £100,000 per year. That will be a £50,000 credit on your tax bill. That £100,000 investment can be spent on one company or a number of different companies. There's no minimal amount, so you can invest £1 or £5 or something like that. Also, you're allowed to elect to carry back to the previous tax year. So if you haven't invested in SEIS this tax year, which is the 2021-2022 tax year, you can invest £200,000, electing for £100,000 to be in the previous tax year, 2020-2021, and then the other £100,000 in this tax year. A company itself can only raise £150,000. So if you're looking to maximise that £200,000, you would be looking for at least 2 companies to spread your investments across. There is a time limit of what's classed as a new company for CDIS, and that is 2 years. The company can only have traded for 2 years, no longer than 2 years, to raise CDIS. What the definition is of trading is a little bit vague. There's a bit of case law about it, but it's about whether you are undertaking enough activity to state you have started to trade. It's when you start to make sales, you don't have to have made a sale. So sometimes there is a technical issue about when you can get your claim forms and when you've started to trade or not. Certainly if you're dormant, you're not trading, but there's some technical issues on that I'm going to address in a minute. So that's the CDIS. So you're talking about 150,000 you can raise in the first 2 years. The investors get a 50% credit. If you compare that with EIS, the former scheme that's been going since 1994, the investors get a 30% credit, and the company can raise up to £12 million in the first 7 years of trading. So depending on what stage the companies you're looking to invest at, some will have CDIS available, some will only have EIS available. But if you're thinking for your companies and raising, those are the kind of dates you need to think about. So if you have any questions about that, specifically about your investments, you can get in touch. So I'll move on. So the type of tax release available are, as I said, the income tax credit. The way the income tax credit works is if you've invested that hypothetical £100,000, you get a £50,000 credit. When you file your tax return, you'd put all of your incomes on your tax return, whether it be employment income, interest income, dividend income, all those things, and then it will tell you what your tax bill should be or is, and then you just apply the credit to reduce your tax payable. So that's how the credit works. What's important about that income tax credit and your own positions, your own tax bills, is you need to use that credit up fully if you want to also benefit from the other tax relief, which is no CGT when you sell those shares. It's the same for CDIS and EIS. When you sell those shares, there's no capital gains tax at all. That only happens as long as you use up that income tax credit. So if you invested £100,000, you get a £50,000 credit under CDIS, you have to use that credit. If you don't, and let's say you only use 50% of that credit, you've only got a tax bill of £25,000 between the 2 tax years, because remember we can do the carryback. If you only claim 50% of the credit, then only 50% of the gain when you sell in the future will be exempt. 50% of the gain will be taxed as normal, which is either your 10%, your 20%, or again 10% for things like business asset disposal relief, or what used to be called entrepreneurs relief. So that's important as well. When you're looking to invest, you should be speaking to your accountant or understand what your tax bill is and how you recover that back against the available credit. There's another capital gains tax relief available when in the year of your investment. So if you happen to have a capital gains tax bill from another disposal of shares or a rental property or something else where you have a capital gain in this tax year, when you're looking to invest in this year, there's a CGT relief if you use those gains and you reinvest in CDIS or EIS. There's slightly different reliefs for both. So let's say you make a £100,000 gain selling a property. So that £100,000 gain, residential property, 18% tax up to the high rate band. Above that is 28% tax. So that would be your tax exposure. But if you took that £100,000 and you invested in CDIS shares, the government will allow you to reduce that gain by 50%. So instead of saying I've made £100,000 gain, you would be saying to HMRC, I actually only have £50,000 taxable gain. So that's a CGT relief deduction when investing those gains into CDIS. For EIS, it's different. It's not a permanent relief. It's a rollover. So if you made £100,000 gain on a disposal and then you invested in EIS, that gain would be rolled over. And when those shares are eventually sold or disposed of by selling, or the business fails, at that point, the original tax would then become payable at that time. How that ties in with the business asset disposal relief or entrepreneurs relief, when people have qualified for 10% capital gains tax on disposal of, say, company shares or something like that, the government has said, yes, you keep that 10% rate into the future, because obviously in the future capital gains tax rates could go up, but you want to be sure that you still are eligible to claim that 10% CGT. So those are the main reliefs at the point of investment and disposal of capital gains tax and income tax. When thinking about what year you're electing to claim your income tax credit in, remember we said we can claim it in the year of investment or the prior year, you have to look at that. If you also want the capital gains tax rollover or reduction under SEIS, you can align those. So with a bit of tax planning, if you're looking to dispose, you can get a few things lined up. So who's it for? It's basically any UK taxpayer, anyone with a UK tax bill, no matter how that tax bill arises, you can invest and get a credit against your income tax bill. It's not a credit against capital gains tax bill, the actual credit. So if you have capital gains tax in the same year, that's treated differently the way I explained it just now. So some of the restrictions, there's some excluded activities, the type of companies that are eligible for the scheme. So the main thing to think about is that it has to be a trading company. It cannot be a passive income business. So that is things like rentals, property rental or asset rentals, anything that has a royalties or dividend income stream through investments, anything passive. Also professional services are not allowable, like banking, accountants, lawyers, insurance, finance, and things like hotels, nursing homes and care homes. Those are seen as essentially passive, because the property is really what people are paying for. There is a possibility, and we have had some some care homes allowed for SEIS and EIS if it is short-term rentals. If it's long-term rentals, it's too passive. If this other care home we had was for children who were only going to be staying for a couple of weeks, a couple of months at a time, and they said that one was fine. So if you have any ones that you're not sure about, just you have my details on this webinar. You can send over some questions and we'll discuss ways and options that you might have to raise some funds through these schemes. So when we're talking about something like property development, the builder, investing in a builder is allowed because that's a tradesperson. But if the business is buying, developing and selling the property, that's not allowed because you're owning the properties. Equally, if you do invest in SEIS and EIS into a property developer, the tradesperson, that company itself that you've invested in cannot provide services to an ineligible trade. So for example, you can't own properties, you invest in a builder, and then they do the building work on your properties because it's too connected. Okay, one of the disqualifying criteria for SEIS and EIS is about connection and control of the companies. So an investor can only control up to 30% of the company. When you are calculating that 30% threshold, certain people are connected with you, and that is the vertical relatives. So it's parents, spouses and children are counted together when calculating that 30% threshold. People who are not connected are siblings, in-laws and wider relatives. Also connected are business partners, and that is, the definition of that is someone who's actually in a business partnership, like a LLP partnership or an unincorporated partnership, are partners. So that control test of 30% can come in different forms. It can be controlling the shares, it can be exerting influence, having clauses in the shareholders agreement that says you can appoint or remove directors. Things like that can come across to HMRC that you have too much control, more than 30%. One of the other things that people talk about quite a lot is whether investors can be paid investors. Sorry, my timer. Whether investors can be paid investors, and the answer is yes, but there is a certain order at which you would have to do three things. One is the timing of being an investor, one is the timing of being added as a director, and the timing of when you actually take paid remuneration through the company. So as long as you become a director before you take a salary, you would be able to be paid a salary for director services or employment services. Very important to get that checked with the accountant first if you're looking to be a paid investor. So that is separate from a contract for services. So if you had, let's say, a marketing company or a consultancy company, and you were going to provide services to this company, HMRC says that's fine. You can provide services from your other businesses, but you cannot be a paid employee unless you are also a director. So just a bit of care needs to be taken around that aspect. Okay, so I've gone through, I think, for what the tax reliefs are for you. CDIS is a 50% credit, EIS is a 30% credit against your tax bill. The CGT reliefs as well. And I think, yeah, we'll talk about the other two reliefs, which is loss relief and inheritance tax. So if the business fails, you can claim the remaining unrelieved amount as a income tax loss. So in CDIS, that example, £100,000 was invested, 50,000 credit. I claim that credit fully. So I have an investment really that's cost me £50,000. If that business fails, I can claim the remaining 50% as an income tax loss against my income tax bill in the year that that investment was has failed. So for EIS, £100,000 invested, £30,000 credit. I've got 70,000 which has not been relieved. Again, I can claim that 70,000 as an income tax loss. That's different from a reduction in your tax bill that the income tax credit is. It reduces your taxable income. So let's say I have £200,000 income, and now I'm going to claim £70,000 as a loss. It means I'm only going to get taxed on 130,000, not the full 200,000. And then my effective tax rate, which is going to be that blended 40% to 45%, I'm going to get my effective tax rate is my tax relief on that. There is a £50,000 general cap on income tax loss that anyone can claim in a tax year anyway. So you just have to be aware of that. The benefit of this scheme is that most people, most of the times, if you invest in shares, those shares will get you a capital loss. So obviously a capital loss is less easy to claim those losses unless you have other capital gains. So sometimes capital losses can go on for quite a long time before you use them up, if at all. The benefit of this scheme is that you can claim it as an income tax loss. So it's more flexible. There's also opportunities to carry back those losses or elect for those losses to be recognised in the previous 2 years. If you can't use those losses fully, you can use those as carry forward as well. So if you're in a situation of loss relief, there's some small technical points, how to claim that on your tax return, things like that. But that's largely how that relief works. So for inheritance tax, there is a relief called business asset relief. If someone does die with business assets that are qualifying, mainly again trading companies, not investment companies, SEIS, EIS qualifying companies will qualify for that relief. It just means that those shares will go down to the beneficiaries tax-free. So as long as you hold on to the shares for 2 years, they qualify for inheritance tax relief. And as long as you hold on to the shares for SEIS and EIS, yeah, so as long as you hold on for SEIS and EIS shares for 3 years, then the tax relief is permanent. It means that you can't sell your shares within 3 years of making the investment. So for CDIS, just explain how you can get the claim forms. The money goes into the bank account first. The shares are issued once the money has been received. That is quite important. EIS cannot be done on the same day as SEIS. There must be at least one clear day difference, but you can invest 150,000 plus. The company can receive 150,000 plus more money straight away, and can issue the SEIS and EIS, 1 day apart. The CDIS funds need to be spent within 3 years, and the EIS funds need to be spent within 2 years. You can't just sit on those. What is the other one? Yeah, so when the money goes in and when you can claim the claim forms is for CDIS, you can go to HMRC and ask for the claim forms the sooner of having traded for 4 months, which I talked about before, what the definition of trade can sometimes be a little bit vague. But when you've traded for 4 months or you spent 70% of the funds, then you can go to HMRC and apply to get those claim forms. For EIS, you have to have traded for 4 months before you can get the EIS relief. So it's important, if you're thinking we have a lead time before we're going to start to trade, for example, before you're going to open a restaurant or something like that, those 4 months can be important. For SEIS, the tax point for that 3-year holding period is the date the shares are issued. So the money can go in now, the shares can be issued now, that's your tax point, count 3 years forward. For EIS, it's different. The 3-year holding period will only start when you started to trade. So if we get the money now, but we don't start to trade for 4 months, then my 3-year holding period will be 3 years and 4 months from today's date. So again, that can be important about holding onto those shares. So common question is, what happens if the business fails within the 3-year period, or if the business gets bought out within 3 years? If the business fails within the 3 years, you still get loss relief, you still keep your income tax relief. If the business is bought, i.e. you've disposed of those shares, then you will lose that income tax relief that you already had. You would have to go back and amend your tax return that you claimed the income tax relief on, and the tax will be due at the original date. You'll owe a little bit of interest. So if a business is looking to sell within those 3 years, buyout or something like that, you would want to discuss maybe going across in the buyout and getting shares in the new company, rather than actual disposing of your shares through that purchase. So those are some things to think about. There is something I'll mention as well. HMRC has a approval process. It's not really an approval, actually, use the wrong word. It's something called the advanced assurance process. So it's not a registration, it's not approval, it's not a certification or anything like that. It's completely voluntary. But what you do is you go to HMRC and you say, this is my business plan, this is my forecast. The forecast will have to justify how much money you're seeking to raise and how that's going to be spent. So there has to be a need for the money, not we're making money and we're going to continue making good money and we just want to get tax relief for the investors. They don't really want to support those kind of things. But you give a business plan, a forecast, people you're actively talking about investing with, because they want to see that you're actively talking about, not just you want the advanced assurance for less certain reasons. You explain how the funds are going to be spent. You send them any amended articles or shareholders agreement that you're discussing. You make the application online. It's not terribly expensive. We charge a few £100 for 1 or 2, both applications, SEIS and EIS. And you can get HMRC to review everything you're doing. They'll come back and say, okay, based on what you've told us, you're okay, you should be qualifying. You just have to stick to all the other scheme rules. And the benefit of that is you can go to your investors and you can tell them that you've told HMRC what you're doing and they're happy with that. So if there's uncertainty about what you're doing, you can get the advanced assurance process. The scheme itself, you have to do a number of things at Companies House, issuing the shares properly, creating a register of members, the shares register. That goes off to HMRC when you're able to get the claim forms, which I explained before. And if you haven't got the advanced assurance already, you would have to send that same information at the time of applying for the claim forms. So if you've done the advanced assurance, normally the claim form process is quite quick. An advanced assurance at the moment, we're getting them back in 5 to 10 days. The claim forms, similarly, maybe a little bit longer, 10 to 20 days, we're getting the claim forms back. So in terms of timing for the investors, you need to be thinking around the end of the tax year, 5th of April, because you might want to invest in this year or the prior year or both. And so the 5th of April is the end of the tax year. The tax point is the date that the shares are issued. Say something else? Forgot. So about stakeholders. So stakeholders themselves have a fundraising platform. Not sure if I'm right in saying it's a crowdfunding, seed funding, Series A type fundraising platform. You're obviously all registered. So they have these deals on their website that you can check out. And you can then try to match to your own personal circumstances, knowing and understanding the reliefs available. This one is Revula, and it says there's EIS available. And that means that you can understand the difference between CDIS and EIS. But if you have any questions about your circumstances, tax, maximizing your tax relief, you can just send me a message and we can talk confidentially.
Very good. Gary, well, sorry, you've got a couple more slides, yes?
No, I think maybe that's it. And then there's some examples in the different type of scenarios, how those tax reliefs work. Oh, and actually, yes, just the final one. So a recent addition to the scheme is this risk to capital condition. They brought this in about 2 years ago, and it's because some of the investments were just a little bit too easy for people to get the tax relief. So they brought in this risk to capital condition that said there has to be a genuine risk, but it's subjective, it's not objective. So basically, if the agent thinks it's a little bit too cozy, you're not really presenting any risk, they will push back on that. So something to look up on is that risk capital condition. Sometimes things like restaurants, they have to have a premises. So owning a property is seen as de-risking because you still have that asset, whereas a short-term lease, they will see that as a risky, normal risk business venture. So think about looking into the risk capital condition, because that can also be important in how you present your business plan and your forecast. If it's too optimistic, HMRC will say, but why do you need the money then for the investment? So there's that balancing act. That's it from me.
Very good, well done. If you'd like to take the slides down, we can head to some questions. I'd actually quite like to lead off, in fact, because we have a format and Stakeholderz comes to the market both to provide equity funding and senior executive talent to technology businesses. But the investing director format, which is the sort of one that you covered, and you suggested that the timing of things about investors drawing salaries, becoming directors, is really important to get right. What more could you add to that? I mean, you were very clear when you said it, but I'm sure there's other stuff that we should be aware of.
Yeah, so the restriction is that you can't basically offer the shares to your employees. There's different share schemes for employees, EMI and stuff like that. And it's just preventing people saying, oh, I've got my employee here, why don't I get them to invest in my business? I'm going to give them a bonus so that they get that tax bill and then they write it off by investing in my business. So they say it's not for employees. So
okay, so that's basically the rule of thumb.
Yeah,
if a director's an employee, you don't qualify, full stop, and you've done it ahead of time.
Yeah, correct. So, but what they say is if you are an angel investor, which they say is if you are a director before taking a remuneration, they'll allow that. So the basic idea is not for employees, but if someone invests in my business and then says, oh, I actually want to take a salary because I want to help out and do some services, become a director first, and then you can take the salary. So it's the ordering is important.
Very good, thank you. We'll head to the chat area now. Did you touch on what is the CGT treatment when EIS shares are sold before 3 years? I think you did actually.
Yeah.
Do you want to add anything more to that?
Yeah, so it's generally two scenarios. One is a disposal, like a buyout, and one is if the business fails. If the business fails, HMRC say that's fine. You'll still keep the tax relief, and then you get that loss relief. If the business is bought out or you sell your shares, you will lose that relief. There's two situations where that doesn't happen. It's through divorces, and through divorces, actually gifting shares to a spouse, I think, is also the tax relief still remains. And through probate, when there's a death, the tax relief is still in place. Okay,
that's good. Thank you. So Nicholas Lenz has asked, what about the following situation? Year one, investor invests 100,000 in EIS investment and claims 30% income tax. Year two, company becomes insolvent and is sold, but no value is realized for investors. So can you then still claim loss relief on the 70%?
Yeah,
remains.
So there is a way to do this. We had a similar situation where someone's business hadn't gone into liquidation, but the accountants were saying, you know, it's only a matter of time before the company fails. And the investor taxpayer put on a tax return to claim what they call negligible value loss relief, basically saying it's worthless. And HMRC came back and they said, no, we're not going to allow that. And so we came up with the idea that what you would do in that situation is you would basically surrender your shares back to the company and just say, I don't want them anymore. And then, of course, you would be able to tell HMRC, well, I've now made that loss. So yes, if it was bought, you run the risk that you've sold those shares, but there's that workaround.
Okay, thank you for that. Richard Martin has asked, is it possible to issue different classes of voting shares, e.g. B shares, which participate above a maximum, above a certain, you know, valuation, I guess he's suggesting. Yes,
so you can have different classes of shares. Obviously, that's quite routine when you go into seed funding, Series A, B, C, etc. So HMRC just want to look at those new class of shares in the amended articles shareholders agreement to make sure there's no preference. So you can't prefer the SEIS and EIS investors. You can't say, I'm going to give you your dividends first, I'm going to buy those shares, I'll pay you back even after the 3-year period and things like that. But you can have different classes that are totally legitimate. It is possible even to say, I'm going to pay class B in a 95 to 5% split first, and then I'm going to change it around in a different format. We've seen those being approved as well. So it's just a matter of checking with someone who knows about SEIS and EIS. If you're not sure, you can keep sending advanced assurance anyway. So we talked about the advanced assurance as a voluntary thing to begin with. If you make a change, like create new classes of shares, you can send that to HMRC in a new advanced assurance and say, is that okay? And if they come back and say no, then you know you need to change that.
Okay, that's very useful. So I think if anyone's questions haven't been answered, you'll pick them up maybe after this event, won't you? Because we can send them to you. There's one that's come back asked by Kelvin Harrison. I think we've actually answered it, but I'm not sure. And obviously he's kindly asked the question, we must get him his answer. So perhaps we could circle back on that if necessary. We have actually got one more question in, John Barnes. So is there any disadvantage in claiming relief as soon as the SEIS or EIS paperwork comes through?
Yeah, so I spoke before about when you can claim, get the tax claim form from HMRC. For CDIS, spent 70% of the funds or traded for 4 months. EIS, you have to have traded for 4 months. So as soon as you get those claim forms, obviously it's just it's to your benefit to put that on your tax return as soon as possible. So if I invest now and I get my tax claim now, my claim form, it's in the 2021-2022 tax year. I'm not going to file my tax return until after the 5th of April. So I can either wait and then reduce my tax bill when I'm paying 31st of Jan 2023, or I can elect to carry back if I have the tax bill there and I haven't used up my allowance. I'll elect to carry that back. And obviously, if I filed my tax return and paid a tax bill already, I'll amend that tax return with the credit and I'll get a refund plus some interest. So it makes sense to try and claim that as soon as possible.
As soon as possible. Very good. Thank you. Another question here. Do other countries have similar schemes, or is this unique still to the UK? I think I know the answer to this, but over to you.
Yeah, I think a lot of the tax authorities across the world do keep an eye on what other countries are doing. I think it's unique in the sense that the rules that we have here, I'm pretty sure they have a similar scheme in the US. Maybe it's industry specific, like they might say you can do that if you invest in the films, those kind of industries. And I think there are some in Europe, like I think there's some in France and Germany, but it's not quite the same. One thing I'd just touch upon as well is that risk to capital condition I was talking about before. There's 2 threads to it. One is the risk, and the other one is how long you intend your business to go for. So this one's a bit of a funny one, but talk about the film industry and why they brought in this condition is because if someone's a good film producer, what they were doing is they were raising 150,000 for SEIS, they were raising 12 million under EIS with all these big investors you've probably seen in the news, creating one movie, you know, hiring the top talents in Hollywood, making a ton of money and going, right, done that one, getting no CGT to close that business down. And then he said, well, let's do that again. So those series of movies and tax reliefs is what they said, no, we're not going to support that. What they will support is if that one company is going to continue making movies, they'll support that one company. But you can't just keep rehashing the same thing and keep getting the tax relief. So we have clients at the moment who say, oh, I've got an idea for a couple of products. I want to raise 100, 150,000 to make one product. And then if that's successful, I want to go and make the second or third. HMRC are pushing back on that and saying, well, we can't see the longevity. If you fail in this one first product, you're not going to continue. So how do you meet that risk capital condition that you are looking for long-term growth? So that can sometimes be difficult, but that shows that it's important about your business plan and your forecast to show that you as the business owner are going to continue the business, even if that investment comes in and doesn't produce the results, you're still going to carry on. So that's something we're seeing a lot more at the moment.
Gary, that's terrific. Mindful of time, I think it sort of allows me really to sort of begin to wind up this webinar. There are a number of questions we'd love to ask the audience about your interest in this event, how we can improve it. There are one or two things we'd love to tell you about Stakeholderz and get a point from you back on. Things like syndicate, we do from time to time and seek investment ourselves, so that might be useful to you for you to know. But it does occur to me that now, at this stage in the tax year, there are some excellent ventures on our platform for you to go and have a look at, and Ravula was mentioned earlier. So if you have got a tax issue, you've probably got one of the world's and certainly the country's most advanced experts facing you on the screen today. Gary, thank you so much for your input. You've answered the questions with an amazing amount of depth, knowledge and insight. So without further ado, Renita, if you'd like to run the exit poll, please, that would be tremendous. And if you could give us your feedback, that would be really kind of you. It is a great way in which we can engage with our market using the webinar and understand and learn more about your needs.
Perfect. I have launched the poll. We'll give it a few seconds and wait for everybody to answer the poll.
So there's some very high comments, in fact, and very kindly coming back. The event that you've been party to this morning seems to have been rated as excellent or good, but mostly excellent. 78%, 80%, 82% have rated this excellent. So that's tremendous. Thank you very much indeed. There is some great feedback there. Appreciated. Renita, should we leave it open for a little while longer?
I think we have got all the responses.
Well done. Okay, that's really good of you. Thank you all very much indeed for taking part. It just remains for me to thank you all for joining us. We hope you found this informative. There will be more webinars of this type coming up, so watch your email. And it's also, as I finally should sign off, I think, on a tax-based webinar, a great time to invest with some enormous tax advantages before the end of this tax year. Many thanks for joining us. Bye for now.
Thanks, Tim.